You're scrolling through real estate listings, and a property stops you dead in your tracks. It's a beautifully maintained condo, but it's priced 20 to 30% below everything else in the neighborhood. It feels like you finally found the one listing the rest of the market somehow overlooked. But in the world of common interest developments, an extraordinarily low sticker price is rarely the result of a lucky find. A price that deviates this far from the local average suggests that hidden liabilities have finally reached a breaking point, forcing their way onto the real estate ledger. When an association's operational costs become unsustainable, the purchase price often drops to compensate for the financial weight a new owner will have to carry. The math starts with a simple rule. Most buyers don't actually purchase a total price. They purchase a monthly cash outflow. This matrix shows the trade-off. Property A has a standard price and a $100 fee. Property B has a slashed price, but a massive $900 fee, instantly consuming a third of your purchasing power. The total monthly outflow is identical, shifting capital to fund deficits. To find any buyer who can actually qualify for a mortgage on that property, the seller is forced to drop the asking price until the total monthly payment aligns with the rest of the market. The cheapest homes on the market are frequently found in older communities that spent years marketing themselves as desirable because of their low HOA fees. This chart shows how dues stay low. Volunteer boards remain popular by neglecting the reserve fund, the savings for major projects like roofs and elevators. The balance steadily drains towards zero. Deferred maintenance reaches absolute failure. When that savings account hits zero, the association is forced to issue a massive special assessment to every owner. A new owner might move into a cheap home only to receive an immediate invoice for $20,000 or $40,000 due within 30 days of closing. These low dues represent a financial penalty that the seller successfully deferred until it could be passed on to the next person who bought into the building. To keep communities insured during the current insurance crisis, many boards are accepting policies with exceptionally high deductibles, often 5 to 10% of the total building value. If a severe storm damages a $10 million complex, a 5% deductible creates a $500,000 shortfall before the insurance company pays a cent. Because most associations do not keep that amount of cash liquid, they immediately split the deficit among the individual unit owners. This flowchart shows that $500,000 gap splitting into smaller chunks of debt that land directly on each owner's front door. Owners are suddenly personally responsible for thousands of dollars in shared deductible liabilities just to keep the building standing and insured. A single storm event can trigger enough shared debt to completely wipe out any savings you thought you gained from a low purchase price. If a property looks impossibly cheap, there is a strong chance that traditional banks have analyzed the association's books and refused to lend money there. Lenders like Fannie Mae and Freddie Mac follow strict guidelines to manage risk. This chart plots reserve funding against delinquency rates. A community lands in this red blacklist zone if reserves fall below 10%, or if over 15% of owners are delinquent. Once blacklisted, traditional buyers cannot obtain a mortgage, eliminating the vast majority of the market. This restriction shrinks the pool of potential buyers down almost exclusively to cash investors. Sellers drop the purchase price through the floor because that is the only way to convince a cash investor to take on the risk of an unmortgageable property. Some buyers believe they can beat the system by paying cash and simply enjoying the low entry price. But buying into a cash-only community means inheriting an unstable asset. When you eventually move, you will face the exact same restricted market. You will be forced to compete for the attention of a very small number of cash-heavy buyers who will expect a massive discount to take the property off your hands. This creates a cycle of depressed value where the liquidity of your investment is permanently compromised. A cheap cash-only purchase today guarantees a major liquidation headache and a lower resale price when you eventually need to sell. You can spot these traps before you sign a purchase agreement by mandating that your real estate agent pull 3 specific sets of documents. First, get the most recent reserve study. This engineering audit shows exactly how much life is left in the roofs and roads and compares what the association should have saved against what is actually in their bank account. Second, review 1 year of board meeting minutes. You are looking for mentions of insurance non-renewals, upcoming special assessments, or disputes over structural repairs. Finally, check the accounts receivable aging report. This document reveals if the community is struggling because a high percentage of your neighbors aren't paying their bills. Performing this audit is the only way to see past the marketing of a low listing price and understand the ground truth financial health of the building. For a first-time buyer with limited liquid cash, buying into a failing HOA can be a catastrophic mistake, as a single special assessment could lead to immediate foreclosure. For downsizers on a fixed income, a sudden spike in monthly dues or a shared deductible will instantly shatter a predictable monthly budget. Even for cash investors, the math only works if the price is low enough to absorb the inevitable costs of structural neglect and rising insurance premiums. Firm, conclusive tone. Completing a thorough due diligence process allows you to protect your capital and ensure you aren't unknowingly assuming someone else's inherited debt. An extraordinarily low sticker price on an HOA property reflects a ledger where the cost of hidden liabilities has finally surpassed the value of the home itself.